Hello and welcome to another video of our series IND AS. So today we are here to present about IND AS2, which is all about inventories. And how we have structured this entire presentation is that we're going to look at the objective of IND AS2, scope, the definition of inventory, net realizable value and the fair value, measurement rule, cost of inventory, cost of purchase, cost of conversion, cost measurement and inventory cost formula, net realizable value with detail on it, recognition, disclosure, key difference with the earlier gap, and the summary. So we'll start the discussion. So we'll quickly move to the first slide and start the understanding of IND AS2. Okay. So objective of IND AS2 to prescribe the accounting treatment for inventories. A primary issue in accounting for inventory is the amount of the cost to be recognized as an asset and carried forward until the related revenue recognized. So how we are going to account for the cost of the inventory before it is being sold? What would be the value at which it would be recognized in the books of accounts, what is the formula at which it would be basis which the accounting is going to happen. So all this is something that we are going to cover as a part of this IND AS. This standard deal with determination of the cost and its subsequent recognition expense, including any written down to the net realizable value. So which means that this IND AS will help us to understand under what circumstances the recognition criteria from the cost would be shifted to the net realizable value, and under what condition those net realizable value should be shown in the books of accounts, and how we have to treat that in the financials. And it also provides the guidance on the cost formula that are used to assign the cost of the inventory, so that we are having the enough comparability and the clarity in the financial statement. And if we compare this with international accounting standards, so equivalent to IFRS, which means that IAS to is which is under IFRS or international accounting standard, and our IND AS 2 is both covering the same scope as far as comparability is concerned with the respective standards. So with this we can move to the next slide and see what is there for us in terms of the scope of this IND AS. Okay, so let's just quickly understand the scope which is being covered as a part of IND AS 2. So IND AS typically applies to all the inventories here. We're talking about inventories. So all things, all the raw materials, all the products that are required to create the final product, which is being sold by the organization or the industry as per the normal operating cycle. So that is being covered as a part of inventory here. What specifically has been excluded are the construction contracts, inventory related construction contract, which is being covered by the IND AS 115, biological assets, which is being covered under IND AS 41, financial instrument, IND AS 109, and likewise inventory related to the insurance contract. So barring these four, everything uh, which is being required to be converted or used to produce the goods, that is being covered as the inventory here, and everything has been accounted as far as inventory is concerned. It is being accounted as per the rules and the regulations of IND AS 2. Uh, Typically, when we look at the way the cost of the inventories are recognized in the books of accounts, is largely based upon the two concepts, which is the cost or the net realizable value. And as we proceed further, we'll come to know that when we record at the cost or NRV, it's talk about the lower of the cost or NRV. But there are a couple of situations wherein cost element is being ignored, and there are two situations. What are those? So one is specific to the produce of the agriculture and the produce of the mineral products. So where largely it is being managed in a controlled environment, and government normally take steps into these kind of materials wherein they have the MSP, minimum support price. And whenever MSP is being issued by the government for these commodities or these prices, then inventory is largely valued at that MSP, and the cost element, that cost to produce, wherein the cost was incurred for the fertilizer or for the seeds or for the other labor, that is absolutely ignored, and it is being valued at the net realizable value. Likewise, for commodity brokers or traders who are dealing in the specific commodities, for them the cost concept is ignored, and they are valued at the fair value less the cost to sell. I'll take a quick example here. Let's say if a commodity trader is trading in a gold and he is holding the gold at a cost of let's say 1 lakh per gram, and in 2 days, if that gold still lies with him and the market value of the gold has increased from 1 lakh to 1,05,000, then it has to be accounted at 1,05,000 rather than 1 lakh. So this is the fair market value, which is the rate which is prevalent in the market in the ongoing scenarios. So that are the two exceptions. Otherwise, largely inventories are valued at the cost or the net realizable value, whichever is low. We'll just quickly move to the next slide and see how that cost element is being recognized. What is the cost when we talk about cost of the inventory? What does that include? What is the cost of conversion? What is the cost of purchase? So we'll move to the next slides and see on all those things. Okay, so we'll touch base upon in what are inventories, what is NRV, and what is fair value. And before that, in the last slide, there when I was talking about the concept of commodity traders when they're dealing with in the commodity, it's being valued at fair value. So that was largely 1 lakh per 10 gram rather than 1 lakh per gram of the gold. So that's a clarification. Okay. Now, inventories are assets which are held for the sale in the ordinary course of business. Finished goods. So again, when we're talking about inventory, it means the goods which are produced and produced and are still available with the organization. So which means that they are available, they are not sold. Those can be finished goods. Typical example, car in a showroom is a finished good. In the process of the production for such sales, for example, WIP, which is like half built furniture, in which we have incurred some material, incurred the expenses, incurred some overhead costs, and it is still in the production in the form of a raw material or supplies to be consumed in the production process or in the rendering of services. So raw materials and consumables, for example, still in the factory. In case of service provider, inventories include the cost of services for which the entity has not yet recognized revenue, which means that they have incurred the cost, they have either raised the bill or in the process of raising the bill, but recognition of revenue is still pending. So typically, when we're talking about inventory, they are in three form: finished goods, which means the production is done, goods are produced, it's available with us. It's only the selling part which is still pending. Second, the goods are still in the production, which is work in progress, and the last one is the raw materials, which means that we have an stock available. Basis the bill of material that this is the amount of raw material that is required to produce a good. So that stock in terms of raw material is available with us, and it is lying with us in a form of stock, which will be used in the future for the production of the finished goods. Net realizable value, what does this mean? It is the estimated selling price in the ordinary course of business, less this estimates cost of the completion and the estimated cost necessary to make this sale. It refers to the net amount that an entry expects to realize from the sale of the inventory of the ordinary course of business. So which means that it is the value that is going to be fetched by selling that inventory. So typically, when we sold the product, the intent is that we should we should add a margin to it, and then we sold it to the market. So which means that if we are selling a product at a value of 150 and the cost of production is let's say 120 or 120 or 125, whatever the case may be, our profit margin is 25. Now this is a typical example. Now if the selling price of that product reduced below the cost of the production, in which case that net realizable value of that production that particular inventory has been reduced, in which case this is the conservatism principle. We need to recognize the inventory at the net realizable value, or the value that is it is going to fetch by selling that product in the market, excluding the cost that is required to sell that particular inventory. So we'll talk about this as we move further in this. And last one is the fair value, reflects the price at which an ordinary transaction to sell the inventory at the principal. So basically, typically, those cases wherein if we do not have a cost or we do have a cost, but we have the fair value at which it can be sold to the market. Specifically in the case of the commodity traders, like we discussed in the last slide, whereby we were talking about the gold, and where 10 gram of gold was purchased at 1 lakh per 10 gram, but when we were closing our books, the price got raised from let's say 1 lakh to 1 lakh 5,000. So in which case it has to be recognized at the fair value, because that is the price at which the inventory is going to fetch in the market if we sold that product in the market. So this is the concept of inventories, NRV, and the fair value. So let's just move to the next slide then. Okay. So what is the measurement principle? As we speak about, inventory should be measured the lower of the cost and net realizable value. So we talked about this in the earlier slide as well. But we need to understand when we talk about cost of net realizable value. So we come to know that what is net realizable value. It is the price which is being fetched in the market by selling that product in the market. But let us just understand the element of cost. So when we talk about the cost, what does cost include? So cost include all the cost of the purchase. It includes the cost of the conversion and the cost in bringing the inventory to their present location and condition, which largely includes inward freight, warehousing cost before production, import duties, non-refundable taxes, and handling charges, insurance during the transit. So what does it include? It includes the cost of purchase, which is the value, which is the price which you are paying to purchase that particular raw material. It includes the cost of conversion, which includes the expenses that we're going to incur in the form of the labor or any other overhead cost. And largely, thirdly, it includes the other costs that are required to bring the inventory to the present location condition. So, which means that if we have incurred some transportation to bring that inventory to a factory before it can be, set into the manufacturing unit within the factory, that cost is also part of my inventory. If we have incurred some warehousing cost before the production, and that warehousing cost is necessary to incur to make sure that we can start our production, or that's a prerequisite to the production, and those are included. We'll speak about this more in our subsequent slide. The taxes that we are paying to the government, if to the extent of the non-refundable taxes and handling charges for insurance. So all these are included as my purchase cost or the other costs which are included in the past part of my cost of the inventory. So we'll have more detailed discussion on these topics as we move forward along with the examples. Okay, so let's just do a deep stick into the understanding of cost of purchase. So what does cost of purchase then include? It includes the purchase price or the price of the raw material that we are purchasing. Import duties other than the taxes that subsequently are recoverable by the entity from taxing authorities. So which means that all the taxes which we are paying to bring the inventory to the location before which we can start the production, those are included only if they are non-recoverable. If they are recoverable, they will not add to the cost of my inventory. Next is transportation and handling charges. Other costs directly attributable to the acquisition of the finished goods, material, and the services. Attributable to the acquisition of finished goods, material, and services. Trade discount, rebates, and the other similar items are deducted at the time to determine the cost of purchase. So let's say if we have availed some trade discount in the form of the volume discount, which are specifically excluded at the time of the invoicing itself, so those will not be added to my cost. So these are like typically inclusions in the cost of the purchase. And we'll speak about it more specifically warehousing cost. We'll speak in detail about that in the subsequent slide. Let's just quickly understand the cost of conversion. So cost directly relatable to the unit of production such as direct material, direct labor, and other direct expenses. These are specifically incurred to convert that inventory from the raw material to the finished goods. And all those expenses, which was labor expenses, direct material, and other direct expenses, which are directly required to convert that raw material into finished products, are included in my cost of conversion. Couple of points to understand the cost of conversion. Systematic allocation of the fixed and variable production overheads that are incurred in converting the raw material into the finished location. So management has to decide a mechanism, and that mechanism has to be bound with a rationale, that how that allocation of the overhead cost specific to the factory setup, which will be included as a part of my overall conversion cost. Fixed production overhead are those indirect costs of production that remains relatively constant regardless of the volume of the production, such as depreciation and the maintenance of the factory and building, other cost of factory management and administration. So all those costs which are required to be incurred to set up the factory, which includes my factory administration cost, which includes the cost of my, if let's say we are taking the factory on a rental, then rental cost is also part of my factory overhead cost that will be included as a part of my, or let's say overhead would be absorbed to the cost of my conversion. So which means that any cost which is of fixed nature, there would be a proper procedure to allocate that cost to the inventory, so that that will be included as a part of the conversion. So variable production overheads, those indirect cost of the production which vary directly, indirectly with the volume of the production, such as the indirect material, indirect labor, variable production overheads, and allocated in each unit. Allocation of fixed production overhead to the cost of the conversion based on the normal capacity of the production. See, what we have typically understood here is that my cost of the conversion includes my direct labor, direct material, and direct expenses. Over and above all the costs which are in the form of the overhead that will be absorbed to the inventory. This is the rational and the allocation percentage that has been aligned or agreed with the management. And that allocation, principle needs to be explicitly shown in my disclosures as well. First thing. Secondly, the allocation or the overhead absorption should be based upon the normal capacity of the production. Normal capacity of production is the expected to be achieved on the average or the number of the periods of season or the normal circumstances taking into account the loss of the capacity resulting to the plant maintenance. So which means that every factory or every unit, uh, basis their experiences and basis the setup which they have done, they are clear that what would be the normal production capacity for that particular factory. So my normal capacity is something which will help me to evaluate the absorption rate. For let's say if I have a production capacity of 5,000 ton on a daily basis, and if let's say I have a cost, so my cost will be allocated on the basis of the 5,000 tons. This is the normal capacity. If my capacity for particular day reduces below 5,000, I will not over absorb the cost to my inventory. What I will do, I will restrict it to the actual production. If my actual production is less than the normal production, then whatever balance is there, that will be charged to my P&L. We'll discuss about that in the next slide. Actual level of production to be used at an approximate normal capacity. Amount of fixed overhead allocated to each unit of production is not increased as a consequence of reduction in the capacity which is planned, and unallocated overhead recognized an expense in the period. So we just spoke about that. In the period of abnormally high production, the amount of fixed overhead allocated to each unit is redistributed or redefined. This is the overcapacity. So which means that our allocation percentage or the allocation basis should be basis the normal capacity. In circumstances where our actual production is less than the normal production, the absorption rate is not going to change. Whatever extra cost that we are incurred would be charged to my P&L in the same period. However, when my actual production is more than my normal production capacity, the allocation percentage will be redistributed. It will be realigned, and the absorption will be happen over the cost of the inventory. So we'll just move to the next and see few of the examples there. Okay. So cost of purchase and conversion, subsequent slide, and then we are talking about other costs. So when we look at the other cost here, what we are trying to say, other costs are included in the cost of inventory onto the extent they are incurred to bringing the inventory to their present location conditions. So which means that any cost which is being incurred to bring the inventory to the place where it can be used for the production, that cost will be included in my cost of inventory. What are specifically not included in the cost of my inventory are the abnormal amounts of the wasted material, labor, or the other production cost, which means that abnormal wastage, abnormal costs are not included. Storage cost, unless these costs are necessary in production process before the production stage. This is very, very critical, and I think we mentioned about this when I was discussing the previous slide, that we'll talk about the warehousing cost separately. So typically when we talk about the warehousing cost, these are the costs that is being incurred to ensure that production can happen in a planned manner. It is very difficult sometimes wherein continuous production is happening, but in that case management has to take a call whether they want to include that warehousing cost into the production cost or not. But as per the principle of IND AS, what it is saying that the production process before the production stage, so which means that a staging table or a table or an area wherein goods are stored before the production can start, or in a typical example where goods require the mandatory storage just to make sure that the goods can be having that waiting period before it can actually be consumed for starting the production. So typically example is alcohol industry, wherein wines or the other respective things needs to be stored for a couple of months before it can be actually consumed for the production of the alcohol. So those kind of storage costs are included in the cost of inventory, but barring that, all warehousing costs should be excluded because that is not required to hold my production. My production is not dependent upon that warehousing. It's just a mechanism to stock the material to facilitate the production. So there's a very thin line. So in those cases wherein it is a continuous production, then management has to take a call and create a rationale that whether they want to include that cost in the cost of production or not, and they have to provide that as a note that they are included this cost basis that rationale. Administrative overhead that do not contribute to bringing the inventory to their present location and condition, and then definitely the selling cost. So what you're trying to say, warehousing cost for the finished good is generally expense in P&L, and it is normally treated as a kind of a selling and distribution expenses, because these costs are not adding to the value of my inventory. These are just there to make sure that I'm storing the goods till the time it is finally being sold to the sold to the market. Because once the inventory is finished, storage does not add any value to bring it to the present location of the condition. So this is a very important concept, and these are like some of the areas wherein very thin line between uh, to uh, to to figure out whether warehousing cost needs to be included or not. So first, all the warehousing cost which is being incurred to store my finished goods should be explicitly excluded. Warehousing cost which is being there to store my raw materials, they have to be taken into the cognizance that only if these warehousing cost is necessary to make sure that inventory is being available to make sure that my production can start, that will be included. And if it is very difficult to find that correlation, then it should be explicitly excluded, and my inventory should not be absorbed with the cost of the warehousing. So we have taken an example here just to show that how the normal capacity, when we talk about in the last slide, how that is being used to used to evaluate the absorption percentage for my inventory. So let's say Akasha Avishkar Limited normally produces a production of 1 lakh units of fixed overhead is estimated 5 lakh. Given the estimates treatment of the fixed production, as per IND AS 2, actual production was 84,000, 1 lakh and 120. So when the production was 84,000, my overhead cost was under absorbed to the extent of 80,000. And that under absorbed cost of my overhead will be charged to the P&L in the same year. uh, uh, in situation 2, normal production is 1 lakh, which is man entire overhead cost got absorbed because my normal production is equal to actual production. And in third case, where my normal production is more than my actual normal production, my actual production is more than a normal production, then there is a redefining the rate of the absorption. So which got reduced from 1 rupees per 5 rupees per unit to it got reduced to 4.167 per unit. So my absorption percentage got reduced, and it will be allocated basis this amount of 4.167 on the total inventory that is being produced, which is like 1,20,000 tons. So this is how a normal absorption happen. This is the normal production. Any underproduction will lead to the under absorption of the cost, and the balance cost will be charged direct to the P&L. But in the case of the overproduction, the normal rate per unit will be redefined, and my absorption will happen on that rate. So with this, let's just quickly move to the next slide. Okay, so let's just quickly talk about the absorption on some of the other elements. So when we are talking about the joint products, so when we are producing something and we are produce a product which can be treated as a joint product, the allocation has to be done on some basis. So in which case allocation will be based on the relative sale amount for each product. So largely the objective here is that in case we want to understand the profitability of a product, then it is very much important that our exact cost should be made available for those products to figure out that whether which product is more profitable and which product is less profitable. Because if this allocation process is not being made available, then we are not in a position to evaluate the actual profitability at the product level. So, in case of the joint product, this can be a problem because the absorption of a percentage is very difficult to allocate, and in that case, either it has to be a rational which management has to decide, or the allocation principle, if it has to be taken, largely it is basis the relevant sale value for each product at the stage of the production. And in case of the byproduct, which are by the nature immaterial, then often measured at the net realizable value, and this value is deducted from the cost of the main product. So which means that in those cases wherein some byproducts are produced, right, and that byproducts fetch some value from the market, then that value or the net realizable value of those byproduct should be reduced from the cost of my production. to come to the final product cost. So instead of showing that byproduct as a profit, it can be reduced profit. It's not the right way. We have to reduce it from the production cost to calculate the per unit cost for that particular inventory. So this is how we normally treat the concept of the joint product and byproduct. A quick example below. In the production process, normal wastage is 4%. 6,000 metric ton of the input were put in the process, resulting into the wastage of 300 metric ton. Cost per metric ton is 1250. Entire quantity of waste in the stock at the year end, compute the value of the inventory. So how we have to compute here? So abnormal amount of waste material of the labor or other production costs are excluded from the cost of the inventory. So we just spoke about this in the last slide, where we see any abnormal cost should be excluded from my cost of the inventory. So we are saying that normal wastage, which is at the 4% on 6,000 metric ton, would be 240. But in this case, my wastage is 300 metric ton. So which means that there is excess wastage of 60 metric ton. And the 60 metric ton is my abnormal wastage. So cost of the normal wastage is 240 metric ton will be included in determining the cost of the inventory at the year end. The cost of the normal wastage, which is 60 metric ton, right, which is at the rate of 1250, that is 75,000, will be charged to the P&L account. So which means that cost per metric ton was 1250, and there was over and above abnormal wastage. So my normal wastage is something which is still being treated as a past part of my cost, but any abnormal wastage will be directly charged to my P&L, and hence the 60 metric ton equivalent cost is charged to my P&L, and it will not be loaded into my cost of the production. So what is not included in the cost then? Abnormal wastage is not included. Storage cost, unless again necessary for production, which is most important. So why we are reiterating this point again and again? Because this is a thin line, because normally warehousing cost sometimes got included by default as a part of my cost of production, which should be looked into very theoretically as well as logically, whether we need to include that cost into the cost of production or not. Administrative overhead not related to the production and the selling cost, these are normally excluded from my cost of conversion. So we'll quickly move to the last slide on the cost of the purchase and conversion. We have one more slide, and let's just see what is there for us to look at that. Okay, so we'll quickly speak about the treatment of the borrowing cost when we have bought the inventory basis the or we have financed that inventory. Let's quickly look at it. What does accounting standards speak about it? So IND AS 23 borrowing cost identifies a limited circumstances where the borrowing cost is included in the cost of the inventory. And when are those? Under IND AS 23, borrowing cost interest is included in the cost of inventory only when the inventory qualifies as a qualifying asset. If it is not qualified as a qualifying asset, then it will not be included in the cost of the inventory and it will be expensed off. What is qualifying asset? Qualifying asset is asset that necessarily takes substantial period of time to get ready for its intended use or sale. Examples of the inventory that requires substantial time for manufacturing inventories that qualify for interest are wine, whiskey, or rum that needs the aging for month and year, cheese that requires a long maturation, large construction inventory, example ships and aircraft, real estate inventory, building under construction of the sale, and customized heavy machinery under the long production. So what does this mean? So it means that if we have procured the inventory for this and we have taken some loans or any other kind of the financial assistance on which we are incurring some interest cost, then that interest cost will be charged to my cost of the inventory. But if my inventory is not qualifying as a qualifying asset as per the definition of AS 23, then entire interest expense will not be charged to my inventory, it will charge to my P&L. So those inventory that takes months or year to be ready, so borrowing cost is added to the cost of inventory. Only inventory requiring substantial period of time to get the qualify for the capitalization, normal inventory borrowing cost is expense immediately. So which means that if my inventory is getting produced within a span of operating cycle, and if I have incurred some interest cost to bring that inventory, that interest expense would be expensed off or charged to my PLL. It will not charge to my cost of inventory. This is a thumb rule. So which means that if I have incurred some expenditure, or let's say I have bought some on the bought some raw material on the deferred payment basis, that deferred payment basis had some element of fixed cost of interest in it, and it will be charged to my PNL, and it will not load it into my cost of my inventory. So let's just move to the next slide then. Okay, so let's just quickly look at the example for the IND AS 23. So we have a situation wherein a dealer has purchased TV sets on the basis of deferred payment of 5,000 per month. The total price on the cash was 56,000 and 5,000 per month, which means that he has incurred 60,000 as the cost, and the total interest cost is 4,000. So in a year, a firm has purchased for 100 TV, excuse me, 100 TV. So 100 TV at the rate of 4,000 would be like 4 lakh. That is my interest cost. So that will be charged upfrontly in the year in which I have incurred that expenditure, and that will be shown as a cost to my P&L. So we'll quickly move to the next slide then. Okay, so we'll quickly spend some time to understand how the cost is being measured. So technique of measurement as per the IND AS is what it is says the technique for measurement cost of inventory such as standard cost. So we have a standard cost method for retail method. We use standard cost take into account the normal level of the material and the supplier labor and efficiency and capacity utilization, which are regularly reviewed, revised, and letter. So typically, when we are talking about the standard cost, it includes the element of estimation, which is being reviewed regularly by the management to establish the absorption rate, the direct cost of the material, labor, and expenses which is being incurred to purchase or bring those material into place, and then we have an absorption rate. So we have a standard cost basis which we do the absorption, and that is the method that is being followed to value the inventory. However, for a retail industry, which is dealing into retail, it is difficult to estimate that method. Then we normally go by the retail method, which is often used in retail industry for measuring the inventory of large number of the rapidly changing items of similar margin. So that is basically basis the gross margin percentage. So the cost of inventory is determined by reducing the sale value from the inventory by appropriate percentage of the gross margin. An entity shall prepare the financial statement on the ongoing concern basis unless management either intends to liquidate the entire entity or cease trading. So typically two methods. For retail industry, we have a margin wherein we can use retail method, but otherwise largely it's applicable a standard costing method that we apply. We have methods to which we can create the absorption rate basis the past capacity or the past trends, and it has to be reviewed regularly by the management to ensure that the right principles are being applied while defining those standard rates. But for retail industry, we change hands very quickly. So for that method, we have retail method rate, which is gross margin rate. So we have illustrated with the have example here. So related retail inventory costing is retail method. A large garment retailer maintains inventory at a selling price in the store system. Selling price of shirts of the inventory is rupees 10 lakh. Average gross margin is 40%. Step 1, convert the gross margin into the cost percentage, which is cost percentage is nothing but 60%, which is my 100% minus the gross margin. Step 2, calculate the inventory cost, which is 60%. If we calculate 10 lakh, 60% of 10 lakh, that is my 6 lakh. So 6 lakh is the cost of the inventory that will appear in the balance sheet under the IND AS 2. So we have to make sure that that gross margin percentage is again established through principles mechanism, whereby we are sure that this is the actual cost and this is the margin at the each inventory item of the trading that we are dealing with. So this is typically how we measure the cost at which we have to show our inventory. So we'll quickly move to the next slide then. Okay, so let's just quickly have a look at the way the cost formulas are being used as per IND AS. So in what IND AS says that if at all we have a separate inventory designated for specific purpose, then definitely the cost would be valued. The formulas is to get that project specifically identified, material specifically identified, and then we have to have the individual cost being aligned or assigned to those. However, when we are talking about the larger production units wherein we have multiple lots being created, then it is very difficult to establish that specific allocation method. So in which case, if we have multiple lots of the same item getting produced at the multiple intervals, then how we should evaluate the cost when we are selling that particular item to the market. So in that case, what has been prescribed by the standard is that FIFO. We have to use FIFO or the weighted average method, which means that we have to make sure that if we are selling the inventory in the third month of the production, then we have to make sure that the items at which we are selling should be used the first in first out method. The inventories which were produced at the earliest will be disposed out first. So that it goes with the principle that our latest our inventory that is still in the stock should represent the actual cost of the production rather than the cost which is being produced at the lesser rate, because every month or every time we are producing the new lot, invariably with the change and the happening of the inflation happens, that cost needs to be tends to be on higher side. So hence we have to make sure that our charge of the cost to the production when we are selling the inventory should be FIFO based, so that we have the realistic margin, and also our inventory should represent the latest cost of the production. We can also use the weighted average cost formula, wherein the cost of each item is determined using the weighted average and the cost for similar item for the beginning the period the cost for similar item. So it depends upon the organization, but prescribed method is the cost of inventory can be assigned using the first in first out method or weighted cost formula. An editor shall use the same cost formula for all the inventory having the similar nature of the use of the inventory. For inventories with different in nature use, different cost formula may be justified. So FIFO, weighted average cost formula, these are two methods. For specific inventory, the specific cost allocated for that particular project will be used to determine the cost. So we'll move to the next slide then. Okay, so let's just quickly talk about the net realizable value. So net realizable value is the cost of the inventory. If the cost of the inventory is not recoverable and this inventory are damaged, and if they have become wholly or partially obsolete, or its selling price have been declined, the cost of inventory may also not be recoverable if the estimated cost of completion or the estimated cost of incurred the make sale has been increased. The practice of writing the inventory below the cost to net realizable value is consistent with the view that the asset should be carried in the excess of amounts expected to realize from the sale of this. Simple. So which means that what? If the net realizable value of my inventory has reduced below my cost of production because of any reason, because my stock got damaged, it got obsolete, technology become obsolete, or the marketability of that product is no more. So which means that the my value which is going to get realized from the market is actually falling below than the cost of the production. So in which case the IND AS 2 permits me to value my inventory at the net realizable value. So I will present my inventory net realizable value and disclose that in my notes to accounts. Inventory is usually written down to net realizable value by the item in such circumstances. However, it may be appropriate to group the similar item of the related item. Estimates of the net realizable value are based on the most reliable evidence available at the time the estimate are made. The amount must be maximum expected to realize. So which means that it has to be based on the estimated value that is going to get realized for those inventory. The most important point that needs to be kept in mind that the raw materials which are used to create the finished product, if the net realizable value of the raw materials have fallen below the value of the cost, then we should also look into the finished inventory which will be produced by consuming those raw materials. And if value of the finished product is still above the net realizable value, then is still above the cost, then we need to value the inventory at the cost, irrespective of the fact that the raw material constituents, the value of that raw material, the NRV, which is net realizable value, has fallen below the cost. So if my finished product, which is being produced from consuming those raw material, if it is still having the marketability and my marketable price is more than the cost, then there is no need to do the NRV for the raw material or the constituent product. But if the value of the inventory finished product itself got reduced and the NRV is is less than the cost, then it has to be valued at the NR. So this has to be kept in mind. So if at all my raw materials are below my cost, but my finished product which will be produced by consuming those raw material is above the cost, then there is no need to do the NRV for those raw materials. So let's just quickly move to the next slide and then see what is it. Okay, so reversal of NRV. So yes, reversal of NRV is allowed if at all in the future year, if it is if my NRV got increased, then we need to reinstate. I need to make sure that inventory are valued at the revised NRV. So typical example, let's say cost is 100, NRV drops at 60. Write down the 40. But let's say if NRV later is increased to 90, then we have to do the reversal in the 30. So this is how we make sure that we should value our inventory at the revised NRV if my NRV got changed over the period of time. So let's just move to the next slide then. Okay, so what about the recognition then? So we'll quickly look at the recognition. When the inventories are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which related revenue is recognized. Matching principle. Amount of any write down of the inventory to net realizable value of and all the losses of inventory shall be recognized as an expense in the period the write down or the loss incurs. The amount of any reversal of any write down of the inventory arising from an increase in the net realizable value shall be recognized in the period in which. So simple. So whenever we are incurring any when we are selling that inventory, so the cost of my inventory would be recognized in the year in which we are selling that inventory. And if at all we are doing some adjustment on account of NRV, so entire written down of cost from cost to NRV that will be charged to the P&L. And then obviously, if at all there is a reversal, that will be a credit to my P&L. Some inventories may be allocated to other asset. For example, inventories used as a component or the self-constructed property, plant or equipment. Inventories got allocated to another asset in which they recognize an expense during the useful life of this. So simply, for example, if let's say I have an item and then item is being getting consumed in one of the asset which is being constructed by the organization, then it will be credited to my inventory and debited to that PPE. For example, if let's say I am a manufacturing, I'm producing some component which can be used in the genset, and let's say if I'm creating my own genset on genset for my own consumption, then if I'm using some of my own inventory, then I will credit my inventory and debit my PPE, which is my genset. And then if that component is included in my genset, the cost would be part of my genset, and then it will be accordingly reduced from the value of my genset over the period of time basis the depreciation on the useful life of the asset. So that's what has been mentioned here. Cost of the inventory is reduced and got included in the cost of other asset, and will be expensed off over the useful life of the asset in the form of the depreciation. So we'll quickly move to the next slide then. Okay, we'll quickly have a quickly on the disclosures then. So what does disclosure says? The accounting policies adopted in measuring the inventory, total carrying amount of the inventory and the carrying amount in the classification appropriately to the inventory, carrying amount of inventory carried at the fair value less cost to sell, amount of the inventory recognized as expense during the period, amount of the any written down of the inventory recognized as expense in the period, the amount of any reversal of any write down is recognized as a reduction in the amount of the inventory, circumstances or event that led to the reversal of the written down of the inventory, and the carrying amount of the inventory pledged at the security. So these are the disclosures that are required to be made and in the notes to the accounts with respect to the inventory, and these disclosures are mandatory. There is no exceptions to that. We have to disclose everything appropriately, specific to the fact the accounting policy that is being adopted and the cost formula that is being used, like standard cost or the retail method. We have to make sure that the total carrying amount of the inventory and the carrying amount is classification appropriately. This is the entity. What is that carrying amount of my inventory? Whether it is my cost or net realizable value. If it's net realizable value, that needs to be disclosed why it is a net realizable value. And in case there is a reversal of the net realizable value, we have to mention that. And the amount which is charged to my P&L on account of the reversal should also be disclosed separately, which is mentioned here. So these disclosures are as per the IND AS 2, which is in line with the IAS 2. So far what we have looked into, that IND AS 2 is largely in line with an equivalent to IAS 2, except for circumstances where there are some minute changes here and there with respect to the presentation, because we normally adopt schedule 3 of the Companies Act 2013. There are some minor disclosure here and there, but barring that principally IND AS 2 is absolutely aligned with IAS 2. So let's just quickly move to the last slide of this presentation to quickly have a look at the difference of the IND AS 2 versus the Indian GAAP earlier. Okay. So difference between the IND AS versus the earlier gap. LIFO was not allowed, is not allowed in IND AS. It was there in the earlier gap. NRV IFRS line more strict. It was less strict because IND AS is largely on the fair value concepts, and that's what which is being the moot principle of adopting the IND AS. Service WIP treated as inventory, not explicitly mentioned. A broker or trader, a mandatory fair value, not explicitly mentioned. Borrowing cost capitalized if qualifying, generally expensed off in the earlier gap. Biological is excluded, it was included. Disclosures very detailed, it was limited. Cost of conversion is aligned with IFRS, and storage cost included only if necessary, but it was more flexibly. There was no explicitly exclusion of that, but it has been only mentioned in the IND AS 2 that it has to be included only if it is necessary and required for the production. So with this, we have come to the end of this IND AS 2 slide presentation. Let's just quickly move to the thank you slide then. This is a thank you slide. So I would like to thank all the viewers and subscriber who have viewed this or who are going to view this presentation. And please, I would request that please review it to till end and let me know with your comments, any feedback that you want me to incorporate so that I can make those changes in the future and upcoming presentation on the further next series of the IND AS. And we are going to come with the IND AS 7 as the next presentation in next couple of days. Please like this video, subscribe to our channel, share this channel and this video with respective users who want to get themselves acquainted with the IND AS principle. And thank you for watching this video. Have a good day and bye bye.